As we approach the end of the year, many of us start thinking about charitable things, toy drives, providing holiday meals for people in need. But one thing is, before we give gifts of cash, there's three things we want to talk about and share with you that can help you save money on your taxes. One that everybody should be aware of before they make any gifts of cash to charities. And then there's two special circumstances that, if you fit those circumstances, taking advantage of these strategies can really mean huge tax savings for you. So by the end of this episode, you're going to learn the three places to be aware of saving taxes and how you can apply those in your life. Hi, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan-Mermel, and I've got a fee-only financial planning practice in Chicago, Illinois. And John, before we proceed with tax tips and charitable giving, let's ask everybody to subscribe. It helps our channel and helps us reach more people and gives us credibility with the people at YouTube.
That's
so,
right.
John, let's get right into this. Tell us your first tip about what people need to be mindful of when giving money away.
Yeah, this is I love this topic, especially as we approach. I don't know why, for me it's always the holidays. I do my personal my giving in dollars, sort of end of the year, and feeling appreciative and grateful, that sort of thing. Maybe it's as Thanksgiving just being the holiday it is and things. But so one of the things is, I know a lot of folks, and I think that you might have mentioned, something like a third of donations to charity come at the end of the year. I mean, some big number, right? And so as we're doing this, right, we're sort of getting in gear and thinking about this. There's one, I was going to call it a mistake. I'm not sure that that's the right term, but there's one place where people are wasting tax dollars, right? They're wasting opportunities that we see all the time in our office, and it's across the board, whatever stage of life people are. And what that is somebody that writes checks to charities out of their checking account and donates to their church or to United Way or to Red Cross or whatever your charity is. And at the same time, they've got investments that are not in IRAs, like in a brokerage account, that have gone up in value. And so you go, wait a minute, what do those two things have to do with each other? I'm writing a check, I've got money, I want to support these causes. And yeah, I got investments, who cares? Well, here's the thing about that is, in addition to writing a check to a charity, one of the options that we have is to give stock or give mutual funds to a charity. So why would we want to do that if we're going to give the same amount? Well, what happens, and maybe I'll just start with an example here. And when you give money to a charity, remember, charities are tax-free organizations. So when they sell investments, they don't pay any taxes on those. We're not tax-free organizations. If we sell investments that have gone up, we have to pay taxes on the gains, right? So, and if it's okay, maybe I'll just jump in with a brief example. I got a friend who inherited some money from their mom, passed away, and they inherited some money. So we're just sort of chit-chatting on things. And he said, well, listen, they've got a bunch of individual stocks. I like to be more diversified. So I'd like to sell these. And for various reasons, there was a low basis, they call it, meaning what mom had invested in the money. I think it was Hershey stock, actually. Mom had invested like 10,000 in Hershey stock, and now it was worth 25,000. And because of the circumstances of mom's estate, that money, if my buddy sold it, he'd pay taxes on that $15,000 in gain. So we're talking, $2,000, $3,000, $4,000 in taxes. And so I said, well, listen, I don't know if you want to give $25,000 to charity, but if you did, you could give that money to charity, right? The charity sells it, they pay zero in taxes on it. You get the tax deduction for the full 25,000. The charity gets the 25,000 to spend on their causes, and there's no taxes being paid anywhere along that line, as opposed to my buddy selling that investment, paying taxes, and now maybe only having $20,000 to give to charity. The charity's got less, he's got less of a deduction. So by giving the stock, we avoid the capital gains on that. And he was like, whoa, I've been meaning to do something good with this money. I need to think. And again, is he going to do all 25,000? I don't know about that. But the idea that if it's 5,000 or some smaller number, he can save money and avoid those gains. So whether it's something that we've invested in and it's gone up, or in certain circumstances, an inheritance that we have to pay taxes on, can be a really great tool to at least be aware of, right? If I'm writing a check I should be thinking, do I have investments that have gone up that I can replace that with?
So there's a lot to unpack there. First, thanks so much for this example. It's great. There's a few things that I would say on your example. First of all, in the vast majority of the situations, when people inherit money on like a stock, they end up getting what's called a step up in basis. And so it's not the situation where the basis is whatever they got it for, like on the day that the person died.
Yeah.
That's the usual situation. Okay. So I just don't want to I want to make sure that people understand that first.
It's not every
Unusual
inheritance, right? This is a
Yeah.
unique circumstance, right? Yep.
But there's plenty of times that people have stock that has gone up in value, and a lot of so maybe you got Hershey stock, and then you just you were a kid, you kept it, and now it's
Right.
you're 70, and you're like, what do I do? I have this Hershey stock. Oh, and one point is that you don't have to give it all. You can give 2 shares. Great. Like, so if that's, if that's what you don't have to give, it's not an all or nothing situation. The other thing is, as a tax preparer, I started doing taxes 25 years ago. And believe it or not, a lot of people don't know how much they bought stocks for. Basis is. So they have no idea. And then like all these, like a mutual fund, the company's changed 5 times. Maybe it's a place that somebody used to work for, and that's long since changed, but now they've got some miscellaneous. They have no idea what the basis is. That's what you have the sales price minus the basis. Which is how much you have to pay capital gains on. And so there's they're just clueless about, and it's very difficult to figure out. So those stocks are other great candidates for just giving those away. And if you're going to give money away anyway, if you're of that ilk, and I think a lot of people are, then you might as well do it in the most tax efficient way possible. If you want to give money to the IRS, you can.
That's right.
And donate to the IRS. That's another topic. If you're interested in that, or donate to the government. If you're interested in that, put a comment and we'll do a whole show.
Yeah, we'll work on that. That's right.
Government. But if you're not interested in donating to the government, you can do it in this more efficient way.
So those are some great details on that, Bridget, and it's a nuance, like so much what we do, right? We can't address every situation, but clearly, those things you brought up are awesome. Two things, like the one takeaway from this after this discussion is, listen, if you have investments where you'd have to pay taxes on the gains, think about giving that, right? It's a red flag. It's a trigger on your end of things to go, I should think about this. The other thing I want to point out is, if you didn't catch it, viewers didn't catch it, and Bridget's started doing taxes over 25 years ago. Since she was in her early teens, she's been doing taxes. So she's an expert on these things, right? I couldn't let that one slip past. So if you have stock, if you have investments that have gone up, hey, should I be giving those? That's the question to be asking there. And that's for everybody, right? There's a couple of specific situations also that can make some sense. And I want to make sure to bring up for somebody that's approaching retirement, meaning, hey, in the next year, 2 years, 3 years, we're going to stop working, and we expect that our income is going to go down from a tax standpoint. Maybe we're in the 24% bracket today, and at least for a few years in retirement, we plan to be in the 12% bracket. That can be a place where you say, well, geez, I'm going to give a certain amount this year and next year and those first 3 years of retirement. And maybe I look at saying, well, geez, should I give 5 years of donations to my church or to my favorite charities and do them today because I've got a higher tax benefit? And tomorrow I might not have such a high tax bracket, and try to take advantage of that, grouping them into 1 year. So, and there's a lot to dig into with this too, but just the idea that, hey, if you think you're going to be in a lower tax bracket in the next couple of years, primarily because of retirement is where we see it, that can be a flag, that can be a trigger to say, you know what, I should think about maybe front loading some of those donations, right?
Absolutely. And I just want to mention again, if people are interested in what I'm saying, give us a comment. Another way to do this in a more fancy pants manner is what's called a donor advised fund. And again, that's a whole nother topic, whole nother show. But that builds on what John's saying. And if you want us to talk about it, we're happy to talk about it, but we don't want to bore people.
Yeah, that's right. So that's one of those things that it can give you some flexibility. So if your income's gonna change, your income's gonna go down, hey, this is a time to think about doing some tax planning. The other sort of age related or time in life related thing is for people that are 70 and a half or over, they have an opportunity to make a donation to charity directly from their IRA and avoid any taxes at all on these distributions from your IRA. And again, it's a trigger. Hey, if I want to give money to charity, if I'm 70 and a half or over, I need to take a look at this qualified charitable distribution strategy and see if it makes sense for me to give money from my IRA right to the charities and avoid taxes.
Absolutely. And we've done a whole show on this, and I'm going to link to that in the comments. So, John, this seems like a great place to wrap it up. So appreciate our details on this to help people get benefit and also to save money on taxes too. I'm Bridget Sullivan Mermalik at a fee only financial planning practice in Chicago, Illinois.
And I'm John Shear. I have a fee-only financial planning practice in Middleton, Wisconsin. Both Bridget and I work with clients all across the country. So if you're interested, you have some questions on some of these strategies to see if they make sense, please reach out to us. Don't forget to hit that subscribe button to help other people find this information. And then Bridget and I are both also members of the Alliance of Comprehensive Planners. If you're interested in more information and maybe finding a planner in your specific area that thinks in a similar fashion to where we do, you can check out acplanners.org. And with that, until next time.